Welcome in. This video is Zbcn coin ready for 700% Big Bang. We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand.
One of the most important signs in technical analysis that indicates an uptrend is progressing in a healthy manner is when the price forms higher highs and higher lows. A higher high means that buyers are still strong in the market and are able to push the price above the previous peak each time. While a higher low shows that even if sellers try to put pressure on the price, this pressure is met at a higher point than the previous low and buyers step in again. However, the fact that the price is currently very close to its most recent low is a sign that this uptrend has reached a critical threshold. In trend structures and technical analysis, it is very important to maintain low levels. If the price falls below this level, a significant deterioration occurs in the market structure, and the likelihood of the uptrend ending increases. At this point, what investors closely watch is whether the price will break this support level. If the price breaks this area, the uptrend is technically broken and sellers can gain more strength, pushing the price to lower levels. In this scenario, selling pressure may increase, declines may accelerate, and investors' psychology may be negatively affected, potentially triggering panic selling. In the opposite scenario, if the price does not break this support and instead bounces upward from here, it indicates that buyers are still strong and the uptrend can continue. In such a case, it is quite likely for the price to regain upward momentum, retest previous highs, and even surpass them. Strong buying from the support zone, especially when accompanied by increasing volume, can be a sign of a much more solid upward move. In technical analysis, as long as the chain of higher lows and higher highs is not broken, the probability of the trend continuing remains high. Additionally, the fact that the price is currently near the last low level can also represent an opportunity zone for investors. Strong support zones are generally advantageous in terms of risk-reward ratio. Positions taken here can keep potential losses minimal thanks to a nearby stop-loss level, while offering a high potential for gains. For this reason, professional investors often closely monitor such zones and wait for confirmation signals that the price has reversed from support. At this point, not only price movement, but also volume data, candlestick patterns, and indicator signals play an important role. For example, a noticeable increase in volume as the price approaches support may indicate that strong buyers are stepping in. Likewise, long-tailed candlesticks, especially those that dip below but close above support, often signal that sellers are struggling and buyers have managed to pull the price up. These types of candlestick formations are important clues that strengthen the likelihood of a rebound from support. On the other hand, if the support is broken, additional technical tools such as Fibonacci retracement levels, previous horizontal supports, and moving averages can be used to understand how deep the decline might get. If the price breaks the current support, the next step could be testing a lower support zone, and whether new buyers step in at these levels will be decisive. However, in the no-break scenario, with the continuation of the upward move and the formation of a new higher high, the strength of the trend would be reconfirmed. From an investor psychology perspective, the price approaching support often creates uncertainty among market participants. This uncertainty can cause some investors to act cautiously and wait, while others may see it as an opportunity and buy. For this reason, these levels are often areas where high trading volumes occur. Institutional investors in particular may view such critical support zones as buying opportunities, which can lead to a quick recovery in price. However, the important thing here is that the support is maintained not just with a brief reaction, but with a strong close. Staying above support on daily or weekly closes is a much stronger confirmation for the continuation of the uptrend. If the price meets these conditions, the likelihood of the upward move continuing increases significantly, and this would paint a positive picture for both short-term and medium to long-term investors. In summary, the fact that the price is currently near its most recent low marks a very critical turning point for the market. The break or strong rebound that occurs here will be the most important factor in determining the direction of the price in the coming period. If the support holds, the uptrend can continue without being broken. If it breaks, declines could deepen. For this reason, both technical indicators and price action will be decisive in investors' decisions, and at this stage, acting patiently, with a plan, and with discipline is extremely important.
The fact that the price is currently above the 200 EMA is considered an extremely positive and strong signal in technical analysis. The 200 EMA is one of the most widely followed indicators by investors and traders to understand the direction of the long-term trend. This indicator takes the price data of the last 200 candles, which can be days, hours, or minutes depending on the time frame, and creates an average price line by giving more weight to more recent data. Therefore, the 200 EMA clearly reflects the general direction of the market and investor sentiment. If the price is above this line, it is generally assumed that the market is in a bull or upward trend. This shows that investors are more willing to buy, the market's upward momentum is strong, and in the long-term perspective, the probability of prices rising is high. In the current situation, the price being above the 200 EMA tells us that the market is already in a generally positive structure. However, at this point, just being above the EMA is not sufficient as a sole criterion. An even stronger signal would be a pullback toward the 200 EMA and a subsequent upward reaction after touching this level. This situation is defined in technical analysis as a moving average acting as support. In other words, the 200 EMA behaves like a support level for the price, and when the price reaches this level, buyers may step in and push the price upward. When this scenario occurs, strong confidence forms among market participants, both technically and psychologically. This is because investors who see the 200 EMA acting as support tend to buy from this level, which contributes to a stronger price increase. In such a pullback and reaction scenario, the continuation of the uptrend is not only a short-term move. Often, such moves can be the beginning of a new and stronger upward trend, especially if the price moves strongly and with high volume after touching the EMA. It shows that the market is in an uptrend based on solid foundations. The volume factor here is a critical indicator, because an upward move accompanied by high volume shows that the market is not merely experiencing a speculative fluctuation, but rather that many investors are taking positions in the same direction. Trading above the 200 EMA and bouncing upward from it also paints a reassuring picture for long-term investors. Many institutional investors, funds, and large capital holders take long-term averages like the 200 EMA into account when opening positions. Therefore, as long as the price stays above this level, the market generally attracts the interest of institutional investors. When institutional investors enter the market, the likelihood of the uptrend being more stable and sustainable increases. This is because these investors trade with large volumes and usually think long-term. Also, the price touching the 200 EMA and bouncing from it means that the trend is testing its strength. In technical analysis, such moves are called pullbacks or retests. For a trend to continue in a healthy manner, it needs to have occasional pullbacks like these. If the price moves upward continuously, investors tend to take profits, which can lead to sudden drops. However, controlled pullbacks and reactions from support levels both keep the trend healthy and strengthen investor confidence. So the price touching the 200 EMA and reacting upward is a sign that the trend is still strong and the bull market is continuing. It is also important not to forget the psychological effect. A large portion of market participants closely follow the 200 EMA and shape their trading plans when the price approaches this level. If the price bounces strongly upward from this level, it causes existing investors to hold their positions and new investors to enter the market. As a result, demand increases and the price rises faster. This chain reaction often leads to the uptrend gaining momentum. That being said, not every touch of the 200 EMA is guaranteed to be followed by an upward move. However, in a strong uptrend and positive market conditions, such touches often trigger the start of a new rally. The price touching the 200 EMA and bouncing upward is considered a buying opportunity, especially for trend-following traders. Therefore, when such a scenario occurs, a strong positive perception emerges in the market. In conclusion, the price being above the 200 EMA and bouncing upward after touching it paints a very positive and promising picture for the future in technical analysis. This strengthens the confidence of both long-term investors and short-term traders. The probability of the uptrend continuing increases, market participants become more eager, and the likelihood of the upward move being stronger and more sustainable rises. If this scenario is accompanied by high trading volume, positive market news, and a strong trend structure, much larger price increases would not be surprising. Especially such a technical outlook is considered one of the strongest bullish signals in bull markets and is always at the top of investors' watch lists. When we draw a line connecting the peaks on a price chart, it forms what is known in technical analysis as a trend line, an important tool that investors frequently use to predict the market's potential future movements. This trend line, especially when it connects the highest points in the past, provides extremely valuable insight into the long-term direction of the price. Such a line often acts as a resistance line, because when the price approaches these levels, selling pressure may increase, which can weaken the upward momentum. However, what is noteworthy here is that if the price touches this trend line, based on past price movements, there could potentially be a massive upward opportunity. In other words, if the price reaches this trend line, technical analysis projections suggest that there could be an enormous potential increase of around 700%, which is a highly exciting scenario for investors. These types of projections are usually based on the assumption that past price movements can repeat. While history never repeats itself exactly in financial markets, investor psychology, supply-demand dynamics, and certain market factors often create similar price patterns. Therefore, a trend line formed by connecting past peaks can also show us potential resistance points in the future. If the price approaches this trend line with strong momentum and reacts strongly from these levels as it has in the past, market participants' expectations will increase further. This in turn becomes a factor fueling the upward move. Especially if this level is reached alongside a rise in trading volume, it strengthens investor confidence and encourages buyers to take positions more aggressively. It's also important to remember that trend lines represent not just the price direction, but also psychological levels in the market. This line drawn from the peaks is visible on many traders' and investors' charts, so when the price approaches it, it naturally attracts more attention. This can lead to what is known in technical analysis as the self-fulfilling prophecy effect. Since a large portion of investors watch this line and act similarly when the price approaches it, price movement can occur in a way that fulfills these expectations. If, upon reaching the trend line, a significant number of market participants believe the price can make a sharp upward move from there, buying pressure can rise substantially, laying the groundwork for the anticipated 700% increase to begin. The way the price approaches this trend line is also crucial. If it reaches the level gradually and within a healthy uptrend, the probability of the upward move being sustainable increases. On the other hand, if it gets there through a steep and speculative move, it may not always be sustainable, because rapid rises often face equally rapid corrections. However, if the price moves upward steadily while drawing strength from support levels, the likelihood of a strong bounce upon touching the trend line is higher. In addition, before reaching this point, factors such as overall market sentiment, macroeconomic developments, sector news, and investor interest also play a role in determining where the price may go after touching the trend line. A potential 700% increase is not just a reflection of technical analysis, but also of market psychology and strategic investing. Such a large target could be seen by many investors as a long-term opportunity. Expectations for such high gains can sometimes lead to excessive demand in the market, which can both accelerate the price's move toward the trend line and spark a stronger upward movement afterward. However, it is important to note that no technical target is guaranteed to materialize. Investors should evaluate such targets with proper risk management and always consider possible scenarios. Another important point is that the trend line can change over time. Price action can form new peaks and troughs, which can alter the slope of the trend line. Therefore, this trend line must be updated. If new peaks form higher than the previous line, even the 700% target can be adjusted upward. Conversely, if the trend line slopes downward, the target levels will also change accordingly. This is why working with up-to-date data in technical analysis increases the accuracy of targets and strategies. If the price reaches this trend line, the breakout scenario, often seen in technical analysis, may also come into play. If the price, after touching the trend line, not only pulls back but also breaks through it with strong momentum, the upward potential can increase even further. In such a case, the 700% target could even be exceeded. However, before such breakouts, it is common for the price to test the trend line multiple times and face selling pressure. Each touch actually helps reduce sellers at that level and allows buyers to gain strength. In conclusion, the price reaching a trend line drawn from past peaks is a highly critical development in technical analysis.
It's not just about seeing a line on a chart, it's the convergence of market psychology, supply-demand balance, investor expectations, and past price action. If the price touches this trend line and starts a strong rally as it has in the past, a 700% gain could be a very real and significant opportunity. For this reason, investors considering such a scenario should apply both their technical analysis knowledge and their risk management strategies for the best approach.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.